For more on what all of this means, though, for the broader equity and bond markets, let's bring in Jeff Sherman, Deputy CIO at DoubleLine Capital. Jeff, great to see you as always. Clearly, yields have picked up quite noticeably apart from yesterday over the last 10 days or so. Is that start of a much bigger move higher?
Well, I think so. We've been in this range for a while, and it's been extremely muted when it comes to rate volatility within the 10-year and the 30-year Treasury market. Obviously, the front end of the curve is pinned down by the Fed commentary. But you saw somewhat a knee-jerk reaction in bond yields after the Jackson Hole Symposium, where the Fed, as expected, announced some form of new type of inflation targeting. And so essentially what the Fed has signaled to the market is that we are going to try to create a steeper yield curve. We're going to keep the front end of the curve depressed. We're going to keep it low. We're not going to raise interest rates, although there is that dependency on the economy that you guys are referring to. But in general, the idea that they would be willing to let inflation run a bit hotter over the medium term than historically have done so signals that they're willing to let the bond market on the back end of the curve, 10s, 20s, 30s, to go and drift higher. And that's what you've seen really since the announcement of that. Yes, there was a dip down a little bit yesterday, but we seem to have somewhat resumed that trend here. So the one thing we just really don't like at these levels is the back end of the yield curve, just simply because of that inflation targeting, and further, it's hard to see a lot of protection from the bond market, at least in treasuries, if there is another risk-off environment. So right now we remain cautious in the back end. We've continued to remain underweight duration for the time being, and we'd like to see how this range goes and see if we can actually truly break out of it.
So Jeff, even if we don't get a stimulus, do you still think the 10-year, the 30-year will be a lot higher than they are in terms of yield this time next year?
Well, I think even without a stimulus, because we are in the world of stimulating through fiscal spending, irrespective of if there's a short-term stimulus or not. So recall prior to COVID, we were running or expected to run north of $1 trillion deficit. And then obviously COVID has changed the rules with the CARES Act and like. So even without the short-term stimulus prior to the election, I do think that the path is higher deficits. There will be the requirement to do some form of transfer payments from the government to the workers out there, unless we get a really strong recovery in the labor market. And I think that's what some of the risk markets are really sloughing off at this point in time, is that we still have a lot of irreparable damage within the labor market. You still have, assuming that the pandemic unemployment assistance numbers, as well as the continuing jobless claims are not overlapping, roughly 25 to 30 million people that are still unemployed. So we need to see improvement in that part of the market. And the way to improve that, just listen to the Fed chairman. We need for some form of fiscal stimulus. The chairman has been saying this for 3 to 4 months. And if you look inside the notes that released or the minutes that released today, you see exactly that same behavior. Their forecasts of this resumption are predicated on there being more stimulus from the fiscal authorities.
Is the market getting too optimistic over the fact? I mean, you saw what happened yesterday. The president abruptly tweeted that stimulus talks are off. Now, I know there's been hope afterwards from his tweets of a piecemeal deal. But if you look at the best performing stocks this week, it's materials. Industrials are doing really well. Energy is doing well. Yields are higher. Right. The message from the markets is the economy's okay, despite 800,000 Americans every single week filing for unemployment claims and a very high unemployment rate and losing some steam in the rest of the economy. So is the market too hopeful here for stimulus?
Yeah, you're correct, Sarah, with that. And also, if you look at the JOLTS data came down of job openings being a little bit lower. So I think what it is there's a little bit of rotation here. The darlings, the top 5 stocks, the tech sectors, people are looking for value and they're shopping around and looking at different things and looking at the valuation. I heard a very famous strategist recently say, if you buy the top 5 stocks at these levels and their implied valuations, you are super bearish on the U.S. economy. So I think what you're seeing is that people are trying to dissect the differences and that cross-sectional dispersion within the equity market and looking for the next leg of the trade. And so I do think people are thinking not just short term, but saying, okay, as I go into 2021, what does the economy look like? And there are some sectors that have been beaten up. You were talking about financials here as well. And so these things are screening significantly cheaper on the valuation. Energy still is very much a wild card. We saw big inventory builds today, even with the hurricanes coming, or it may be downgraded to a tropical storm by it hits land. But in general, what you're seeing here is that people are looking for other parts of the market. So we don't look at short-term whims day to day. Yes, the president's caused some volatility here. Obviously, the debates are important tonight. Will there be more debates? There's a lot of stuff going on in the election, but I think people are trying to posture for what 2021 looks like, and not just saying stimulus or not. We know that we're going to need to borrow more money to do this. The Fed has also discussed their minutes, maybe the need to increase asset purchases. I don't think asset purchases these levels really affect the bond market, but what it does, it opens the can for fiscal to be able to print money, issue treasuries, and the Fed can gobble them up.
Perhaps why the rally got extended after minutes. Jeffrey Sherman, thank you very much.